All right, today we're cracking open the Trader's Toolkit. We're going to demystify the huge range of strategies and tools they use to make sense of the financial markets. So, what are they actually looking at when they stare at those charts? Let's dive in. It really all boils down to this one question, and the answer isn't some secret formula. It's actually a whole collection of different analytical methods. Think of it less like a magic wand and more like building a complete workshop, where every tool has its own specific job. So, first things first, before you can use any of the fancy tools, you have to learn how to read the canvas itself. Every trader has to start by understanding the fundamental blueprint of the market's price action. At its very heart, market structure is just about figuring out which way the river is flowing. Is the market climbing? Making that classic staircase of higher highs and higher lows? Or is it falling, creating lower highs and lower lows? Just getting that basic direction down is the absolute first piece of the puzzle. Okay, so within that flow, there are two really important signals you got to watch for. First is a break of structure, or BOS. That's when the price just keeps on doing what it's been doing. It breaks the previous high in an uptrend, for example. It's a confirmation, a green light. But a change of character, or CHOCH, well, that's a warning shot. That's when price breaks the pattern against the trend. It's the very first hint you'll get that the trend might be running out of gas. Now, to actually draw this all out, traders use these core tools. Support and resistance are basically floors and ceilings that price has respected in the past. Trend lines, they're just the angled version of that, kind of guiding the price along. Supply and demand zones are hot spots where a ton of buying or selling happened, and price often reacts there again. And fair value gaps, they're like little vacuums in the chart, imbalances that the market often wants to come back and fill in later. All right, let's grab the next set of tools from our kit. See how this all builds? Once you have the blueprint mapped out, you can start looking for recognizable shapes, or patterns, that have shown up time and time again and tend to lead to predictable results. And these patterns usually fall into a few main buckets. You've got your breakout patterns, like triangles, which basically tell you a big explosive move is coiling up. Then there are reversal patterns, like the famous head and shoulders, which can signal a trend is about to die. And on a micro level, you have candlestick patterns, which give you tiny clues about the real-time fight between buyers and sellers. Okay, let's level up. We're moving on to a more advanced section of the toolkit now. This next batch of tools is a bit more complex. They rely on really specific, rule-based systems and even mathematical relationships to forecast where the market might turn. The Fibonacci tool is a huge one in any trader's arsenal. Here's the thing. After a big move, price almost never keeps going in a perfectly straight line. It has to pull back or retrace to take a breath. This tool helps predict where that pullback might finally stop and turn around, all based on these key mathematical ratios that are found all over nature. Pretty cool, huh? And using it is actually pretty methodical. You find a clear market move, say from a bottom to a top, and you literally just drag the tool across it. It then projects these critical percentage levels onto your chart. Traders then keep a close eye on those levels, especially the 38.2% and the famous golden ratio at 61.8%, looking for the price to bounce. Now, if you want to zoom out and get a much bigger picture, there's Elliott wave theory. The core idea here is that the market doesn't move randomly. It actually ebbs and flows with the psychology of the crowd, swinging between optimism and pessimism. And that swing unfolds in a predictable 5-wave pattern up and a 3-wave pattern down. It's almost like having a roadmap for the entire life cycle of a trend. Now here's the crucial part. This isn't just about drawing squiggly lines on a chart and hoping for the best. For any pattern to be a true Elliott wave count, it has to follow these 3 non-negotiable, unbreakable rules. If even one of them is broken, the count is invalid, it's off the table, and the analyst has to start over. And if you thought that was precise, harmonic patterns take it to a whole other level. These are really complex geometric patterns with cool names like the bat or the butterfly. Every single point in the pattern has to line up with a specific Fibonacci measurement. But when they do form correctly, man, they can pinpoint potential reversal zones with incredible accuracy. All right, so we've mapped out the structure, we've spotted some patterns. Now let's look at the trader's dashboard. Indicators are basically just math, calculations based on price and volume. Think of it this way. They don't drive the car for you, but they give you that crucial data on speed and fuel to help you make much better decisions. And this brings us to what might be the single most important concept, confluence. Look, no single tool is a magic bullet. It just doesn't exist. The real skill is in finding several different independent tools that are all screaming the same thing. That's when traders get really confident in a setup. Indicators pretty much fall into three main groups. You've got your momentum indicators, like the MACD, which are all about the speed and strength of a trend. Then you have oscillators, like the RSI, that tell you if a market is maybe overbought or oversold, which is super useful when things are choppy. And finally, volume indicators show you how much conviction is behind a move. Is everybody on board, or is this move built on nothing? So one of the absolute strongest signals you can get from an indicator is something called divergence. Just imagine this. The price on your chart is hitting a brand new high, but your momentum indicator is actually making a lower high. That is a massive red flag. It's like your car is still rolling uphill, but you can hear the engine sputtering and dying. It's a huge warning that the underlying power of the trend is fading fast. Okay, for our final section, let's talk about how the chart itself can be a tool. Sometimes just changing your perspective, looking at the market through a different lens, can filter out all the distracting noise and make the real trend pop. See, a standard candlestick chart gives you the raw, unfiltered truth of what's happening. Each candle represents a fixed amount of time. But these alternative charts, like Heikin-Ashi or Renko, they work differently. They're actually indicators in and of themselves. They average out the price moves to smooth everything out, which can make trends look way cleaner and easier to follow. And believe me, the toolkit can get weird. For instance, there are traders who use moon phases. Yeah, you heard that right. They believe the lunar cycle affects our emotions, which in turn affects how we trade. It just goes to show you, if someone thinks they can find a consistent edge in something, they will turn it into a tool. So after all that, what's the big takeaway? It's this. A great trader isn't the person with 100 different tools they barely know how to use. A great trader is a master craftsman. They've picked just a handful of tools, they know them inside and out, and most importantly, they know how to use them together to build a clear, cohesive picture of the market. Which really brings us to the final question. For you, the market gives you the raw data, but the toolkit you choose to make sense of it all, that's a deeply personal choice. It's all about finding that unique combination of tools that makes the market story finally click for you.